I started investing in stocks in 2000, maybe 1999. I turned 7 grand into 200 grand. I think I'm living the dream. Unfortunately, that 200 grand quickly dropped by 80%. Yeah. And I was depressed, right? I was 30 years old. I'd accomplished something. I was taking care of my family. And now I lost seemingly all of it. This is still embarrassing to admit after all these years. I have an advanced degree. I have an econ degree. I was an accountant. And I never thought about real estate investing.
Michael, welcome to the show.
Thank you.
Thank you for making time. I know you're a busy guy. You got a lot going on, 50,000 plus YouTube subscribers, a book, one rental at a time. For those who aren't familiar with you, we're obviously going to unpack this. We're going to talk real estate investing. Give us the brief backgrounder. Who are you? What do you do?
So I think my story is probably most interested the audience because it doesn't really start till I'm 30. Right. So I'm a Gen X, which means I was raised to go to school, get a good job, work hard, climb the corporate ladder, retire at 65, and life happens. I started investing in stocks in 2000, maybe 1999. I turned 7 grand into 200 grand. I think I'm living the dream.
Yeah.
Unfortunately, some of my later investments in Enron and WorldCom did not turn out well, and that 200 grand quickly dropped by 80%. Yeah. And I was depressed, right? I was 30 years old. I'd accomplished something. I was taking care of my family. And now I lost seemingly all of it. In reality, there was still 40 grand left, but it didn't feel that way. So I remember walking through a physical bookstore and finding the purple book that a lot of my generation found called Rich Dad, Poor Dad. And this is still embarrassing to admit after all these years. I have an advanced degree. I have an econ degree. I was an accountant. And I never thought about real estate investing. Nobody in my world or my universe owned rental properties. Didn't even know it was a thing. And it changed my life. It set me on a new path because I realized that the stock market in today's ilk, crypto, is all a casino. And I wasn't smart enough or aligned enough or connected enough to make hay. I was eventually going to bust out. But I knew real estate was physical. I knew it had been around forever. You hear these stats about 90% of millionaires make it in real estate. It was just like, okay, I can figure this out. So unfortunately, I lived in the Bay Area, Mountain View, California specifically, so I wasted a year trying to invest in my backyard. Because after you read Rich Dad, Poor Dad, which is a mind shift book, it's not a how-to book, you read every other book. And all the other books said, invest in your backyard because it's close. Doesn't work, didn't work for me. After a year, my wife, Olivia, who is far smarter than I, sat me down and says, we're going to try something different because I'm done looking at houses with you. And we pull out a California map. We find Fresno, California, and we never stopped. We ended up buying a property there about 2 or 3 months later, 1818 North Drive East, and the rest is history. So we've been in one market for almost 20 years.
Yeah. What was the year you bought that first property?
2001, December of 2001.
2001. And then I remember from reading your book, which, by the way, we'll link it up in the show notes, but everybody should get a copy of it because I've read a number of real estate investing books. But I think the cool thing about this book is, it comes from the perspective of, if I can say, like a real human being. You know what I mean?
Yeah.
Where it's not like so far up here, like even Rich Dad, Poor Dad, like you said, it's kind of a mindset book. Yep. But then who Robert Kiyosaki is, that whole persona just seems like completely, you're obviously, dare I say, a regular guy, right? Yeah. All due respect, sure. Right? I mean, a guy who's just done a lot of hard work, right, in building his portfolio, but so anyway, I think that's what's really refreshing about your book is it's very relatable because you lay out your journey and your path.
Yeah, the good, bad, and the ugly. I mean,
right.
There are plenty of mistakes discussed in that. And really what people don't realize is I've written 2 books. One Rental at a Time gets all the press. It's very well received, bestseller, 1,500 reviews, whatever. Mm-hmm. But I wrote that book for myself. Mm-hmm. Because what I realized after retiring suddenly at 45 is I needed a purpose. Mm-hmm. And the first thing I wanted to do was look back. I can visually remember walking to Borders bookstore in Stevens Creek Boulevard on the corner of San Tomas and finding the purple book. It changed it's that much of an inflection. So this book, One Rental at a Time, is what happened after that. Mm-hmm. I never found a book about somebody telling me all the good, bad, and the ugly. You got to remember, if my purchase is in 2001, that means I did 8 deals up till the crash. I did something really, really cool at the peak that not many people did that saved my ass. And then I was buying all the way down to the bottom, and I borrowed $1 million in private money, and I have done all this stuff. Yeah. It's a journey. It's not a how-to book. It's here's 15 years in the making. Let's go.
Well, obviously, there's a little bit of how-to sprinkled in there.
Sure.
But So back to the timing. That's what was interesting to me as I was reading this. Was you started in 2001? You bought how many properties before 2008?
We had 8 houses, so
Yeah,
6 houses in a duplex.
And if I recall the timeline, I guess the big picture I got from reading it is, it seemed to be very fortunate timing. Right?
Well, yeah, you look like a genius in hindsight, right?
Right.
But here's the deal, right? So 2005, you're from Southern California. You undoubtedly know a guy named Bruce Norris.
Sure, yeah.
So I attended a Bruce Norris event in 2005, and he has this report called the California Crash.
Mm-hmm.
So I'm sitting there in the audience. I think I'm, big shot with 8 units, 7-figure net worth now, and this guy's telling me my world's going to end.
Right.
And I don't know who Bruce is at the time.
That. Yeah.
And I'm like, I might want to go look this up, right? I might want to go look this up.
Yeah.
So I do what I always do. I dove in the numbers. I validated what he was saying. I validated what he was doing, and I took action. So from the day we saw Bruce Norris, I think it was a Wednesday or Thursday. It was one of those, San Jose, real estate meetups, California Crash. Less than 10 days later, we had Norris Drive listed for sale.
Really?
And it sold. And then we sold one. We would always have one going, and we sold all 8 or 6 properties, the houses in duplex within about a 6 or 7 month period. And not only sold, we actually 1031. There's a big difference.
Right.
So we go from 8 units to 80 units. And we sold the last house kind of the last month of the peak, if people go back and look at it. And then the world ends, right?
Yeah.
And I'm like, damn, that was good timing. Bruce, you're a genius, man. Bruce, you're a genius. So.
Do you still follow Bruce?
Absolutely. I just went to an event. I spoke at an event here last weekend or the weekend before.
Yeah.
And I said yes because he was speaking. I wanted.
I remember seeing him. I didn't go to that, but I'm curious. Then, what's he forecasting right now?
You had to. He's what did he call his latest report? It was uncertain times.
Yeah.
Because again, right? He's affordability. He's job loss. He's all those things. And he's like, not this time. He's basically calling for 5 to 10 years of sideways.
Sideways?
Sideways.
Really?
Flat.
Interesting.
Right. Price. We're talking price.
Yeah.
So no crash.
Okay. Well, that's good because obviously a lot of people want to kind of get some understanding of where the market's headed. And that's kind of the general theme we're hearing. We're going to talk more about that. Let's come back into kind of your journey. So you bought, the houses you did during that right time. You saw Bruce Norris. He's like, hey, the world's going to end. You're like, okay, let's sell or 1031.
Well, let's validate, right?
Okay.
Right. So
validate,
again, we validate. We're like, damn, this guy knows what he's talking about.
Yeah.
Affordability.
A lot of people didn't believe him, though.
No, they didn't. They fought him.
Yeah.
Why would you fight him? Why don't you just go check for yourself?
Right. He's got the data.
He's got the data. I mean, again, he talks about the experience with the home builders and like the world's going to end. Like, you guys, anyways. If you hear something from someone from a noted source who has data, just go validate it. Because
exactly.
again, he could be reading it wrong. Your market might be different. He was obviously a SoCal guy.
Right.
I'm Central Valley. But go. He's got receipts. Go look at the receipts. So I took action very quickly and got out of Dodge.
That's nice. All right. So you took the bulk of those properties in 1031,
correct,
right, into multi.
Yeah, from 5 to 20 units. So we went from 8 to 80 units in about 6 months.
Then, if I remember from the book, is you tapped into the REO market.
Yeah, so then the market rolls over.
Yeah.
It was the first time we took a pause for about 6 months because it was like an earthquake went off, like a massive earthquake. Yeah. And that property we sold Norris Drive for $264 goes to $300 and ultimately goes all the way to $75. I mean, Fresno got murdered.
From $300 to $75.
$75.
Get out.
No, crazy.
Wow.
Crazy, right? So I start buying again when single families like Norris Drive start selling for $150. I'm thinking half off. Let's dip our toe in, right?
Yeah.
So we start buying all the way down. We've started buying again roughly around $150, and the last house we bought was $28,000.
Was there? I'm curious to get technical for a second. Sure. Back to Norris Drive, because I know in the book you referenced talking about something about pricing and watching the pricing increases in the MLS. Are there certain metrics in terms of like market timing? This is more so just me asking. What are some of the metrics you look at? Is it days on market? Is it times, how quick they sell?
Yeah, it's really how it's called inventory turnover. I want to know, is inventory turnover accelerating or decreasing? It really is that simple. So today, for example, it's decreasing. Even though we have net new listings, which are below last year, we have months of inventory rising. It's the fact that the velocity of the turnover is declining. Those are the things I'm looking for. And
of course, as you know, it's very specific to the market you're in. Sure. I was looking at some data the other day on a website, and pulling up kind of the local. What is the average how many homes are sold for over asking.
Sure.
You know, and I'm still seeing in certain markets a lot of homes sold for over asking.
Yeah, so there's usually the devil's in the details. So one of the things that most people should do today, and this is because the Federal Reserve broke the housing market. The housing market's just broken.
Yeah.
So what every investor should be doing, or home buyer, frankly, they should be going and finding what their median home price is for their area.
Okay.
You should draw that line, because what you're going to very, very quickly see is the metrics below the median are almost polar opposite above the median. The farther you get away from the median price into luxury, the slower it's getting.
Right.
Everywhere.
Yes.
The farther you get away from median on the low side, the more accelerated. It's almost like having two housing markets, right? You're getting turnover, first-time home buyers, and FHA, VA buyers. They're buying the stuff below the median. Luxury stuff is stacking up. So some of these numbers get distorted when you have a balance leaning towards luxury.
So you think that because it's so active on the lower end of the market, that's what's skewing the over ask?
Yeah, well, if you're looking numerically, there's most likely.
And is that because the demand is obviously still really weighted on the lower end?
Yeah, there's no inventory and there's almost no buyers, but the fact that there's any buyers means you still have a supply-demand imbalance.
Well, it's funny because I looked at the stats recently for Clark County, and if I remember correctly, I think it was 1,200 homes sold in the month of September, perhaps.
Yeah, it was pretty bad, 1,287 or something,
Yeah, so that's bad, what, comparatively to normally 3,000 or something?
Well, I mean, historically speaking, I follow a guy named Brian Leba who puts out monthly stats. He's been doing it for 10 years, so he's got receipts as well. Yeah, you're down like 50%.
50%.
Yeah, from 2019, right? So even if you strip out 2020 and 2021, which are astronomical, even go 19, you're down 50%. It's just wild that the market's broken.
Okay. So a lot of the people listening and watching are obviously as mortgage professionals.
Sure.
They're in the market of originating loans and working with real estate agents and working with potential buyers. Any directional or just if you could say anything to that audience, right, to give them either the truth, right?
Yeah.
What is the truth? Let's just go there.
So again, I look every day. I'm making offers almost every day. I've been in this game for 20 years.
Yeah.
What I would tell mortgage professionals, and by that happenstance, real estate agents, the same thing is, the next 4 months are going to be the slowest 4 months of my 22 years of investing. That means if you want to look at it that way, you can get all scared, but you should also look at this like, okay, this is the time to grind. This is the time to get my experience up. This is time to look at other things like the 5% down, fourplexes, house hacking, skill up a little bit. Because once you get to the bottom and you survive, it's time to grow and thrive.
Yeah.
You can't reverse the trend until you get to the bottom. Great news. The bottom's 4 months out. Let's get to the end of January. Let's get to the brand new spring selling season. Let's get to slightly lower mortgage rates. Let's get to the fact that unemployment doesn't blow up to 12%. It stays at 5%.
Right.
The economy's not that bad.
Yeah.
It's going to be a much better place come spring selling season, which for most markets starts February 1st. So I'm encouraged, but don't get me wrong, dude. The next 4 months are going to be wicked slow.
Yeah. So it's really about survival of the fittest.
Oh, it is. It's get your months of life right. Make your expenses right. And it's also about growing. A lot of people in this game don't realize how much growing and networking you can do for free.
Yeah. Yeah. So it's also like prepare for the oncoming windfall. That's the pent up demand again, the buyers. Yeah. So if we do see rates, which by the way, to that point, you see a lot of these, headlines, if you will, about, so what happens when rates come back down, right? Buyers are just going to flood back into the market and prices are going to go up.
Sure.
Are you agreeing with that?
Well, I think there's two things. Let's take the other side first.
Okay.
Because I deal with this every day. So there is a talk track out there that says when rates fall, inventory is going to rise and prices will fall. There's the talk track.
Right.
That's the doomers. That's what they say.
Uh-huh.
So I agree with that to a point. And the point is, how low are rates? If rates fall to 4% again, which again, I'm not calling for, I'm just playing the what if game.
Sure.
That could happen.
Yeah.
That would unlock an ungodly amount of demand because essentially, again, the Fed broke housing, the move-up buyer's out. The move-up buyer's like, I'm out, sitting on the sidelines, not going anywhere.
Yeah.
But you take rates to 4%, people are like, damn, I got all this equity.
Right.
I'm going to go get that house. So if rates go to 4%, sure, that could be, you could theoretically see a supply build so quickly that it impacts prices. Now, is it possible? Sure. Is it likely? Come on. Really? 4% again? That was kind of an anomaly.
Yeah.
Let's hope we don't go back there. So let's talk about what really happens. I think best case for mortgage rates in 2024, we end the year with a 6 on it.
Okay.
6.6, 6.7, 6.8, something mid 6s and above.
Mm-hmm.
Could it be low 6s? Sure. But what does 6.5% mortgage rate do? It doesn't unlock supply because people are sitting on 2s and 3s and 4s and 5s. So supply doesn't come.
Mm-hmm.
But it does unlock demand because the consumer is a fickle creature. Why is the consumer locking up today? Because 8 is bad.
Mm-hmm.
Why did they lock up last year? Because 7 was bad.
Mm-hmm.
Why did they lock up in August before that? Because 6 was bad. But the consumers get used to it.
Yeah.
And the longer we stay at 8, the better 7 feels.
Mm-hmm. Yeah.
The longer we stay at 8, the better 6 feels.
Yeah. It's just a new normal to adjust to, right?
Yeah. So, if we stay at 8 for the fourth quarter, that's why I'm telling mortgage brokers, all we got to do is get to February 1st.
Mm-hmm.
7's going to feel amazing.
Yeah. That's going to move people.
Oh, because they're going to feel like everybody wants a deal.
Right. Right.
And if you stick them around at mortgage rates at 8% for 3 months or 4 months, and suddenly it gets to 7, I mean, it doesn't even have to go very low 7s. It could go to like 7.5. And you're like, damn.
I know. It's funny how different 7 feels than 8.
Yeah, by the way, it goes to 7.5.
It's so close to 10.
Right. I go to 7.5 and I get the seller to kick in 0.5%. I'm
Right.
at 6.99. Damn, I'm smiling. I'm listening to Dixie.
Yeah.
So we just got to get through the next 4 months.
Clarify a little bit, if you don't mind, when you say the Fed broke the housing market. Just what do you mean by that?
So for 2 years, the Fed kept rates low. I don't think that's a surprise to anyone.
Right.
A lot of people look at the home buying market, which we had transactions that were above trend. We did about 6.6 million. Trend's more like 6 million. So we had 2 years of an extra 1.2 million housing transactions. Right. So that makes real estate agents happy.
Yeah.
Why are mortgage brokers happy? Because you're not only involved in those 6.6, you had all of the refi business.
Right.
And some of you had multiple refis with the same borrower. So let's not kid ourselves.
Yep.
And so the Fed has everybody locked in at sub 3, sub 4. The real estate market for 100 years has been entry level, move up, luxury.
Mm-hmm.
The Fed has taken the move up buyer and crushed them.
Right.
They're not selling the entry level home because today, I mean, I ask anybody watching this, you bought your entry level home for $300,000 at 3% mortgage. Your payment, I don't know, make up a number, $1,500 bucks.
Mm-hmm.
You just had a kid. You just got a better job. You now have to buy a house in a different part of town with an extra bedroom.
Mm-hmm.
Now instead of $300,000, it's $350,000. It's not much more. It's $350,000, right? No big deal. But unfortunately, your rate's not 3; it's 8.
Yeah. So
your payment's double. I mean, do the math.
Yeah.
Most people look at that like, nope, thanks, I'll commute. Nope, thanks, I'll get bunk beds.
Yeah.
We're good.
Yeah.
The market's broken. And it'll be broken for years. That move-up buyer's not coming back unless, to our earlier point, rates go sub 4. Rates go sub 4, move-up buyer's back, they're partying, they're sitting on a bunch of equity. But how likely are rates going sub 4? Not very.
So then if you're talking to a real estate agent, mortgage broker, then where's the market of the future? Is it going to be mostly first-time home buyers? And then, the 3 Ds, right? Divorce, diapers, and
well, I think there's 5
death.
Ds, right?
5 Ds, yeah.
5 Ds, right? There's divorce, death, divorce, diapers, and diplomas.
Oh, yeah? Okay.
Those 5 things still happen. People still graduate, people have babies,
Right.
get divorced. So again, there'll always be a market. Even when rates were 18%, we did 2 million transactions in 1981. So the market never stops.
Yeah, I mean, we're still expecting to do roughly 4 million this year,
Correct.
right? And
3.96
that's kind of our, aside from the anomalies of COVID and everything, that's kind of the running average it's been for a while?
No, I would say for a while, the average total transactions was far closer to 6.
Again, that's probably because of the super low rates we've had.
No, that's pre-2021.
Is it really?
That's like 19, 18. Like
Okay.
if you add new homes and existing, 6 million is. far more than
adding
6.
new homes into that. Yeah.
New
Okay,
homes.
great. Separate out the new homes. I always just do that.
Oh, do existing? Okay,
Yeah.
then it's far more like 5 million. Yeah.
Okay, interesting. All right. So I'm sorry, I might have interrupted, but back to the 5 Ds or the, because I'm always about, in these types of markets, you've got to, like, you can't be a generalist. You have to be a
Right.
specialist. You have to identify the truly motivated,
Right.
right? And so those are like the 5 Ds. But is that, if you were, selling real estate, what market would you be identifying to try and find the truly motivated?
So if I was a real estate agent today, I would do one of 2 things. Well, the first thing I would do today is I would create an online presence or booklets of all the new home builders in my area.
Okay.
There was a time where builders weren't paying commissions.
Yeah.
They are now. And I say this with practical experience. I just bought $1 million property in Henderson, and I got my agent paid. Mm-hmm. They weren't doing that a couple of years ago. I registered him. He got paid. He didn't have to do anything. He was showing us around. I was looking at all these other existing homes, and this was just the best deal. So I went to Lennar, registered his name. He got paid. So what I would do as a new agent today, and the reason I would do this is builders will bake in closing costs. They'll bake in interest rate buydowns. Yep. How do you get a 5% mortgage rate today? You go to a builder. Mm-hmm. That's what I did. I got a 4.99 30-year fixed from a builder. Mm-hmm. And my agent got paid. So the first thing I would do today is I would go figure out every home builder that is out there. I would create pictures and relationships and this, that. I'd have every floor plan wired. I would do walkthrough videos. And I would, if I had to feed my family today, I'd be selling new homes left, right, and center today.
Yeah, because it's pretty much like guaranteed traffic.
Guaranteed traffic. You can get rates. Hey, you can buy this existing home for the exact same price at 8, or you can buy this brand new property with a 5.5.
Yeah.
How do you like me now? And oh by the way, I can get you a closing cost credit. Oh, by the way, I can get you some flooring credit.
Right.
Come on.
Did you use the builder's lender?
I did use the building lender, but they ended up selling the loan. But yeah, I
Sure.
mean, that was a whole deal, right?
Yeah.
Yeah.
I'm just thinking about that from the angle of the lender watching or listening. Makes sense for the realtor, perhaps, depending on the builder, right? Because they're often looking at new lender relationships. Depends how big that is, if it's a nationwide thing or not. But there's always those opportunities.
Your question was realtor, so I answered.
No, I know. I'm just thinking for those lenders that are listening. Go, what about me, right? The lender.
No, it's fair. Absolutely.
I know a lot of lenders who are builder lenders.
Yeah.
So
I would do this again if I had to sell. I like to go where it's easiest to sell, and for whatever reason, there's just this inkling that working with builders is hard or it's not fruitful, and maybe for a long time it was.
Yeah, it was. Yeah, for sure.
But again, like the rules change.
Right.
It's changing.
Relationships are always in flux.
Yeah.
All right, so back to this whole Fed broke the market. Part of the reason why rates were so good is they're buying mortgage-backed securities, right? But they're done.
Yeah, and they're selling. Yeah, exactly.
Yeah,
rolling off.
I mean, not
QT.
that. Yeah, right. Do you think they should re-up that and start buying?
No. I actually have a controversial view on this. So the Federal Reserve, going all the way back to Alan Greenspan, did something called the Fed put. Simply said, for the audience out there, basically it allowed Wall Street to lever up bets to crazy levels, get all the upside and none of the downside, because we, the tax-paying public, bailed them out.
Sounds like Wall Street.
It's Wall Street. And that annoys me. I believe capitalism only works best when the wins are counted and the losses. Mm-hmm. The Fed put made the losses not count. So I believe one of the things that Powell is trying to do, and he's come out and hinted at it a couple of times, but never was explicit, he's trying to kill the Fed put. So he's trying to cause pain on Wall Street.
Really?
Oh, absolutely. He's trying to cause pain on Wall Street.
Seems unusual for a politician.
Well, he's not a politician.
Well, yeah,
yes,
but still, he's in tight with Wall Street.
Well, I mean, that's where he came from. But I think Jerome Powell looks at this right now and goes, I can either be Arthur Burns or I can be Paul Volcker. And if you don't know who Arthur Burns is, he's the guy pre-Volcker that allowed inflation to take off. He doesn't want that reputation. Jerome Powell has had a great life. He is worth $1 gazillion. He doesn't give an F.
Yeah.
He's like, when people talk about me in 50 years, I want them to think of me as Volcker and not Arthur Burns. That's what he's playing right now.
Well, it's funny. I've never heard the name Burns, though, because Volcker's always been the one called out as the guy who did spike rates.
He did that to beat inflation. But Arthur Burns is the guy that let inflation run wild.
Oh, okay, so
he's the previous.
The guy had no choice when Volcker came in.
Yeah, Volcker looks like a hero because he took the other guy's playbook and flipped it upside down and says, I'll beat this thing.
Interesting. Very interesting. Okay. Not to geek out on all that MBS. All right, let's pivot to investing.
Sure.
So part of what I do during these interviews is get a little coaching myself.
All right.
So I was thinking about this question when you showed up here today. And you obviously on your YouTube channel, which is One Rental at a Time. By the way, that's where to find all his links, One Rental at a Time. Go follow the YouTube channel. Tons of great content. 5 videos a day going up on YouTube. Insanity. What are you doing today investment-wise? Let me ask that question first in terms of real estate and buying.
So the first thing is, I've kind of hinted at it earlier, we just picked up a gorgeous property here. So my focus the next 3 or 4 months is tricking that out, because when you buy a brand new property, there's no backyard, there's all this.
That's not a personal for you. That's an investment.
No, it's a personal property, but it's just, I'm enjoying the fruits of my labor. I just want to be I'm clear with that. So Not doing anything on the investment front for the next 3 to 4 months. But my intention is to build up a new community, and I'm going to build up a rental portfolio in Vegas, aka Henderson.
Really?
Probably starting Q1 of next year. I'll be looking to do that on residential, so 4 and below. I may be looking to buy brand new construction because I have a big portfolio in California I made 1031 out of, right? 1031 out of 1950s build into 2023 build, probably a good thing. So there will be a lot of movement. I will be moving plenty of my equity to Vegas,
Really?
/ Henderson over the next 12 months.
So you're bullish on Vegas?
I am, yeah, what I've seen so far, absolutely.
Yeah. So the numbers, even though, we've got the whole, well, it's not what it used to be, right? Back to the meltdown in 2008 where it was the infrastructure of jobs and the diversity.
Oh, it's completely different. I was here. I mean, I in 2006 when I was selling my homes, Vegas was one of the markets I came to. Why I didn't choose Vegas? I'm like, oh God, you got like kind of one industry here.
Right.
In
Exactly.
2006, I'm like,
now
out.
It's a whole different thing.
Why I didn't choose Texas? Property taxes. You guys reset your property tax every year? You're going to kill my cash flow every year? No thanks, out.
Yeah.
So that's why we stayed in California.
Interesting. Okay. All right. Now, part 2 of that question is, you kind of answered it in that you're sitting tight. You said earlier, like let's kind of wait it out, interest rate wise, anyways, until like March timeframe. So if somebody's sitting on cash right now, and they're looking at, right, they've read your book, they're like, okay, man, I get it. One rental at a time. Slow growth is fast growth, right? You're sitting on cash. What do you suggest?
Most people are excited or buzzing about real estate investing and they've never done the work. So what does do the work mean? I think everybody needs to define a buy box. All right, what's a buy box? So a buy box is a set of criteria that produces an active list of between 20 and 40 properties.
Okay.
So it's very finite. It's very constrained. And why 20 or 40? I say this as someone who worked a full-time job, had a growing family, and only had 20 minutes a day. In 20 minutes, you can generally go through a list of 20 to 40 properties.
Yeah.
So what you should be doing is setting criteria, looking at that criteria every day for 90 days and tracking what changes. What gets sold? What comes back? What has a price drop? What do they rent for? What's the property tax? What are insurance? Because at the end of the 90 days, the only thing that matters is what is an average deal in my buy box. Most people have no idea. They can't answer that question. They go online, they look at 3 yellow houses, and they buy the blue house. Well, why'd you buy the blue house? Well, I don't understand, right? I only want to buy the best deal. And I can't tell you what the best deal is until I know average. So most people are not focused enough. Most people don't have the daily discipline. Most people are all over the place. And the answer is right in front of you. How do you learn a language? 1 day at a time. How do you learn to play an instrument? 1 day at a time. How do you learn a new sport? 1 day at a time and practice. So real estate investing is a skill. Let's go learn the skill. And oh, by the way, if you're out there and you have money, there's no cutting the line. I can't tell you how many people say, no, you don't understand. I got $100,000, $500,000, $1 million.
Yeah.
What the fuck? You want to lose that faster? I mean, what are you doing? I mean, really? Is that what it's a race to lose money now?
Right.
No jumping the line, no cutting the line. So you got to do the work. You got to learn average. So again, back to the earlier point about the next 4 months being slow. Awesome. Take the next 4 months, get a buy box, learn it, network, figure it out. I will tell people if I do buy something between Thanksgiving and Christmas, which I've done almost every year, it'll be a flip because I find a distressed property on the MLS and I buy it for 30 or 40% off. I did it twice last year. I'll probably do it again this year. But how do I find them? I look every day, 6:30 a.m. every day. Like.
Where are you looking? Where do you log on to?
I use realtor.com. I don't have any fancy access.
Yeah.
I wrote my whole book on buying out of the MLS.
Right.
No door
knocking. Do you have like a good agent or something locally that hunts for you? Or?
Well, I have lots of agents that try to hunt for me. Lots of people in my network.
Yeah.
By now, I usually know the agent or know somebody in the brokerage.
Right.
I'm calling the listing agent a lot.
Yeah. Okay. Interesting. I wrote down something that you mentioned in your book, yield versus cash flow.
Oh, yeah.
Because what I'm trying to think as you're saying buy box and things like that is give people a sense of how do you know when it's a good buy?
There you go. So one of the things there's really 3 factors, and I give this spreadsheet away. It's in the book, I think. You need to know how much cash comes out of your pocket. That's typically down payment, closing cost, make ready. So that's the denominator, aka the bottom number. The top number is expected yearly cash flow, which is just rent minus all your expenses, right, for the year. That produces a percentage. Okay, so I call it yield. Some people call it cash on cash, return on capital, whatever you want to call it. I don't care. But how hard is my money working? When you do this 90-day exercise, what you'll find is you'll figure out the average, right? My average is 6.1%, just making it up. A good deal, in my opinion, is 1.5% higher than average. So in that case, it would be 7.6. A great deal is 1.5% higher than that. So it would be 9.1. It is really that simple.
Okay.
Today, and I'm being very clear, because I have no idea what's coming next year.
Yeah.
We are only doing great deals. So you are only doing deals 3% higher, cash on cash, than an average deal after you've done the work, right? A minimum of 3% higher. That's a great deal.
Okay. And well, we're obviously in Vegas, and I don't know, obviously Fresno's kind of your where you cut your teeth a lot.
Sure.
To what degree do you think those opportunities exist today?
Really hard today.
Yeah.
The only way to get there today, you can do them either with a distressed seller because they have a time problem, or better yet, and again, folks, go look up Robert G. Allen. He wrote a book in the 80s. I just bought version 1 in 1980.
Did you really?
Off of Amazon. Yeah, it should be showing up today or tomorrow. So it's 40 years old. It's 45 years old, right?
Yeah.
1980 he wrote this. And the only way you got deals done were creative financing. Right. And that doesn't mean sub-2 and novation and all these other things. This means have the seller take a second. We did 2 million transactions when rates were 18% because sellers were taking seconds. They didn't have an option. So you can take a second. You can say, hey, no payments for 5 years. You could do that. You could do it, hey, you'll take a second, but at 1% or 2%, right? Look up imputed interest and all of that, which I'm sure you guys know about. But you can get creative. If you can find a seller with equity that needs to move, structure a deal. One of the things that I'm doing now is something called a 50-40-10. This is for your lenders out there. If you have a 90% CLTV, which is combined loan to value, you're in the catbird seat. I would build content around 90% CLTV all day long. What you do in this situation, you find a seller with 0.5%, 50% equity. You go, you know what? I'm going to come in at 50% purchase, right, with the first mortgage. I'm going to have you take back 40% second, and then I'm going to bring 10% in. So if you do this right and you structure the 40% second at a below market interest rate, you can actually get 90% leverage with a 5 handle on the combined interest rate, right? So you just got to be more creative, man. You got to work.
Well, yeah, and understand the different financing options because most too many people are vanilla, right? They stick to just what are the programs that I look at on my sheet every day, and that's what I have to sell. Yeah. Which reminded me earlier, you kind of mentioned, what is it, the new 5% down on a fourplex?
Fourplexes and triplexes, game changing.
Yeah,
game changing.
Now, of course, cash flow is the issue with that, right?
Well, again, if you're going to house hack it, it's not.
Okay, yeah.
Yeah, so this is only for owner-occs. It's not investment. Right. So only owner-occ. So again, if I had to do one thing in my life over again, I would have bought a fourplex when I was 20 years old.
Yeah, house hacked.
House hacked in the Bay Area. You know what that thing be worth today?
I know.
Oh, goodness.
Right.
I'm that old.
You wouldn't be here. You'd be like.
Yeah, it'd be like my hopscotch to my house in the Miami Beach or something. But yeah, fourplex. If I was in the mortgage business, I would go figure that out.
Really.
And I would do content because again, basically the story is live for free. It's not even cash flow. But it really is cash flow. So let's just take some real numbers. Let's say your rent is $1,500 a month. Just it's kind of average, right? Oh, by the way, I could find a fourplex where I could buy it for $800,000. The mortgage after I put 5% down, which is $40,000, right? 5% of $800,000 is going to be, I don't know, $200 or something. You're going to get rent from the other 3 units, which FHA is going to take 75% of, so it's going to help pay that. You're going to have your job. You're going to get approved for the loan, so that's cool. But you're going to take your $1,500 a month you were paying in rent, and maybe now you're going to pay $600. And you're the owner of an asset.
Yeah, plus you get appreciation.
And you get appreciation and all of that. And what do you do with the other 900? You start stacking. And here, what I would really do again is I would buy a fourplex every 18 months. I would probably own 16 units, and I could be done.
Never done a fourplex, so maybe you probably know in terms of qualifying, right? Is that going to be based on the borrower versus
It'll be on both, right? So in the loan, and people should research this because it's still coming out. I think it's 4 weeks away. Yeah. You're going to get credit for 75% of rents. Okay. And then your income. Because you're going to be living in one unit.
So then they'll use some of the rental income to support that.
Yeah, 75%.
Okay. All right. Cool. Well, that's good. That's a lot easier. That's almost like like I know you're into commercial as well, using the property.
Correct. Absolutely. Exactly right.
Speaking of commercial, let's quickly transition there. I've heard you, if I'm correct, I'll characterize it like this: maybe be bearish on commercial?
Oh, well, I don't know. It depends on if you own a bunch of commercial and you're in some bridge debt and you're an LP, you're probably in bad shape.
Yeah.
I happen to have been warning people for a year and a half to avoid that stuff. So I'm sitting pretty again. And my intention in about 18 months is to 1031 out of residential into multifamily because the level of distress that's coming is ungodly. Jeff, you remember the mortgage crisis, right?
Yeah,
what people call the Great Recession. Right?
Yeah, we lived it. Yeah.
What people don't realize, you will, the pain of 07, 8, and 9 was created in 05. The vintage of 05 mortgages was particularly atrocious.
Yeah.
But we didn't see it blow up until 07.
Yeah.
And then those didn't get foreclosed because of the timeline until like 8 and 9. Right? We talk like 9 and 10 was all this. It was 05. So commercial, 2020, 21 are going to be some of the worst vintages for commercial deals. Just like residential, they have 2-year, 3-year IOs. They have unrealistic assumptions. They have brand new operators who are nothing but Excel jockeys. They couldn't operate a building to save their lives. And this stuff's going to blow up in spectacular fashion. And we're seeing some headlines already, but that's nothing.
Yeah.
Right? We saw that 3,200 units in Houston that lit $100 million on fire in 10 months. We just saw a building in San Francisco that sold for $550, $549 in 18, retrade at $240. The pain's just starting. And I look forward to, I'm going to do what's in the book. I'm going to sell a house and I'm going to 1031 into a multifamily, but that's probably 2025. We're like in the very first inning of this.
What's the hangover that's caused this commercial situation? Is that related to COVID and everybody working remotely?
It's the bad debt structure.
It's the bad
we
debt
got
structure.
stupid.
Okay. Yeah.
Well, I mean, let's talk
Shocker.
about 05 again. In residential, my belief is the research I've done is 51% of the loans originated in 2005 were ARMs of some type.
Yeah, yeah.
13 or 14% was particularly atrocious pick a payment nonsense. Remember those?
Oh, yeah. World Savings? Remember that?
Yeah, absolutely, right? Countrywide, all that stuff.
Yeah.
So what did we do in commercial recently? We got bridge debt, which means short, like uber short term, 1 and 2 year IO, because again, you couldn't make the deals work full payment. Let's only do interest only. Oh, come on.
10-year IO, baby.
Yeah, baby, let's go. And then, oh, by the way, you know what? I know rents have gone up historically 1.5% a year. Let's assume 5. And we got 5 last year. Let's do 5 again. And oh, by the way, let's get this no-name operator who's got a few tech friends with some money and give him a fully leveraged 80% LT. I mean, we did some stupid things.
Right.
We just got to pay the price. And by the way, the cake's in the oven. You can't change it. There are going to be billions of dollars lost in LP capital. But again, capitalism is what it is, and I'll be around the corner to pick up the pieces.
So what's the future for commercial? You got a crystal ball there. It's like, with this whole, now we're hearing people are being called back to the offices. So, remember the whole vision of all these vacant office complexes? Yeah,
I think so. If we just talk commercial office,
I
think the doom loop is still there in some cities. Like San Francisco is a particular train.
A lot of issues going on there.
Yeah, there's a lot of government issues that are doing that. But generally speaking, in most, downtown areas, I think the death of office is greatly exaggerated.
Yeah.
I certainly think there will be some conversion. I think for a long time there's been what I'll call C-class office that was just out of dated, that didn't really make sense for the technology worker of today.
Yeah.
That stuff's going to turn into storage, be torn down, or converted somehow. But the death of office
is overhyped.
Is overhyped.
Okay. I want to flip to the book just so I get it right here before we run out of time. Are you still doing pride of ownership rentals?
Oh, I love that you asked that. You really did read the book. Sometimes people get my book and they didn't really read it.
Oh, no, man. These guys know. I prep.
I greatly appreciate that. So, so let's what is a pride of ownership rental? So, again, I suddenly retired in 2018 out of nowhere. I'm bored off my ass. I write a book. I got to find something to do. So I find a particular passion buying what I call slumlord properties. Just disgusting.
By the way, when I read that, I got this vision of Joe Pesci back in that movie, whatever it was.
I buy some really wrecked stuff, really bad. I bought one that should have been torn down, and we reinvigorate it.
Yeah. And
for 2018, 19, and I think Q1 of 2020, we bought and sold 56 homes, flipped them all. And I sold them to landlords. I wanted to help landlords get started. Today, that's called turnkey. I had no idea what that stuff was called. I was just bored off my ass. But I haven't been able to buy one that made sense since early 2021. So, no, I haven't done one in 2 years, I don't think.
Got it. So are you then also, if that's the same thing in your book, where you have this friends and family kind of pool,
Yeah.
right? Is that the same thing?
Same thing, yeah, friends and
okay.
family. So I basically have, so again, I'm about exceeding expectations.
Yeah.
So one of the things I've been able to do, because I have a track record, is I have friends and family that are willing to loan me millions of dollars.
Sure.
Right?
Yeah.
So what I did for them is I did what was called a 6 and 20. So I would borrow the entire purchase price, $100,000.
Right.
I would fund the repairs. Now I could have borrowed everything, but that's not how I roll. I want to have my skin in the game first.
Right.
So I would pay them 6% interest only every month, so just like a credit card or your mortgage payment. And then what I would do is when the property sold, I would give them 20% of the profit. So every deal I was in and out in 6 months. All of my operators earned about 22 or 23% on blended average on their money when you annualized it.
Right.
I happened to make 85 or 90% of my money because I was in for a lot less, right? But yeah, we did that, but I haven't been able to use that money in
You just
3
don't
years.
find those opportunities right now.
I'm not really looking that hard. Let's be clear.
All right.
But yeah.
So earlier in your book, you were kind of like anti-flipping, right? But so is that situational, or what's your take on that now?
If you have a demanding job that brought you to 3 different continents in a week, you have a growing family, you have 1 day off a week, which for me is Saturday, back when I was doing this, flipping is nearly impossible.
Right.
Yeah, don't get distracted. Too much risk. Too many things go sideways. Don't waste the brain cycle. Buy and hold. Just move on. But if you happen to be bored and you happen to have a network and you happen to have contractors that you know, trust, and respect, flipping's a great business. I did it 56 times in 30 months. So it can be an amazing thing, but it's a lot harder than these shows make it look.
I was just going to say, right? Yeah, but you have to know what you're doing. You need to have a team that you trust.
I could
Understand
not have
the
done
math.
it. Absolutely.
I mean, there's a lot of ugly you don't see on HGTV, right? The huge losses.
Absolutely right.
And especially in today's market, like some of your videos on YouTube, so you've had some guests talking about that.
Oh yeah, $100,000 losses, not uncommon.
Yeah, which is more important to get with somebody who you can trust with their information, which, by the way, perfect segue to the book, right? How you like that, huh?
Nicely done.
So, hey, if you haven't yet been inspired to get a copy of this book, please do so. One rental at a time. Amazon or?
Yeah, Amazon. Yeah.
Yeah.
It's also on Audible.
Right, or Audible, or go right to the website, onerentalatatime.com, plus the YouTube channel, Instagram, all the good stuff. Hey, man, this has been awesome. Appreciate it very, very much. Listeners, you know what to do. Get the stuff we talked about. If you like this episode, leave us a review, and we'll see you on the next one. Bye for now.